In the last few days, a significant financial development has shaken global markets and captured the attention of policymakers and financial experts alike. A new digital currency, launched by a leader in Africa, has ignited widespread debate and concern, particularly in the Western banking sector. The digital currency, touted as a potential game changer in global finance, has not only challenged the current status quo of financial transactions, but also led to an unprecedented response from Western financial institutions. The reactions have ranged from cautious skepticism to outright hostility, culminating in the freezing of assets held by the country's financial institutions and businesses and Western banks. To understand the full significance of this development, it is essential to explore the context in which this digital currency was launched. The country, which has experienced years of economic hardship and political turmoil, has been striving for greater sovereignty over its resources and financial systems. With many of its citizens living in poverty and facing high unemployment rates, the government has sought new ways to address these challenges. This has included exploring innovative financial technologies, such as blockchain and cryptocurrency, to bypass the traditional banking system that has often excluded many of the nation's people from accessing basic financial services. By launching its digital currency, the government has opened up new avenues for economic growth, offering its citizens an alternative to the traditional banking infrastructure that has often been inaccessible or unaffordable. The digital currency, built on the secure and transparent framework of blockchain technology, promises to provide a faster, more efficient, and more inclusive means of conducting financial transactions. With the potential to cut down on transaction fees and reduce reliance on intermediaries, the currency offers a promising solution to the financial exclusion that many citizens have faced for years. The currency's launch was not merely a financial maneuver but also a political statement. For too long, developing countries have been at the mercy of international financial institutions such as the International Monetary Fund (IMF) and the World Bank, which have often imposed harsh conditions on loans and aid packages. These institutions have been accused of perpetuating a cycle of debt and dependency, leaving nations trapped in a vicious circle of borrowing and repayment with little room to maneuver. In this context, the decision to launch a digital currency can be seen as an attempt to break free from this cycle and assert greater control over national economic policies. The currency offers the possibility of reducing the influence of Western banks and institutions, which have long held a monopoly over the flow of capital in and out of many African and developing countries. With this move, the government aims to create a more self-sustaining and resilient economy, one that is less vulnerable to the whims of foreign financial markets and institutions. However, the reaction from Western banks and financial institutions has been swift and severe. In the wake of the digital currency's launch, several major Western banks have taken the drastic step of freezing the assets of the country's central bank and key financial institutions. This move is being interpreted as a clear attempt to undermine the credibility of the new currency and to send a strong message to other countries considering similar initiatives. The freezing of assets represents a direct challenge to the sovereignty of the nation in question, signaling that any move to circumvent the established financial order will not be tolerated. The freezing of assets is not just a financial blow, it is also a powerful geopolitical statement. By cutting off access to global financial markets, Western institutions are attempting to isolate the country and deprive it of the ability to engage in international trade and investment. This is particularly concerning for the government, as access to these markets is essential for the economic survival of any nation in today's globalized world. Without the ability to transact in global currencies and access international financial systems, the country may face significant challenges in maintaining its economic stability and securing the resources necessary to support its population. In addition to the immediate financial repercussions, the freeze on assets also raises broader questions about the power dynamics in the global financial system. The actions of Western banks highlight the extent to which global finance is still dominated by a small group of powerful institutions. Despite the rise of alternative financial technologies such as cryptocurrencies and digital currencies, these institutions continue to hold significant sway over the flow of capital and the rules that govern international trade and investment. This power is not easily relinquished, and it is clear that any challenge to the status quo will be met with resistance. However, this incident also raises important questions about the future of digital currencies and the role they will play in reshaping global finance. Digital currencies, particularly those built on blockchain technology, offer several advantages over traditional financial systems. They are decentralized, meaning that they are not controlled by any central authority or government. This gives individuals and nations greater control over their financial transactions and reduces the potential for manipulation or exploitation by powerful financial institutions. Furthermore, digital currencies can provide greater financial inclusion for the millions of people around the world who are unbanked or underbanked. By eliminating the need for traditional banks and financial intermediaries, digital currencies can open up new opportunities for economic participation and empower individuals to take control of their own financial destinies. This is particularly important in developing countries where access to basic financial services is often limited or non-existent. Despite these advantages, the launch of a new digital currency is not without its challenges. The initial reaction from Western banks is a clear indication of the resistance that digital currencies will face from traditional financial institutions. These banks have significant vested interests in maintaining the current financial order, and they will likely use every tool at their disposal to suppress the growth of digital currencies that threaten their dominance. This could include regulatory crackdowns, asset freezes, and other forms of economic pressure aimed at stifling the growth of alternative financial systems. At the same time, the rise of digital currencies has the potential to empower governments and individuals to bypass traditional financial systems that have often been hostile or exclusionary. For many developing countries, digital currencies offer a pathway to greater financial sovereignty and independence. By creating their own digital currencies, these nations can reduce their reliance on Western institutions and take control of their own economic destinies. This could help to promote greater economic stability and growth, particularly in regions that have been historically marginalized by the global financial system. Moreover, the adoption of digital currencies could foster greater economic cooperation between countries in the global South. By creating a new digital currency that is not tied to the traditional financial system, countries could begin to form new alliances and trading blocs that are less dependent on Western financial institutions. This could help to shift the balance of power in global finance, creating a more multipolar world in which nations have greater autonomy over their economic policies. The digital currency also presents an opportunity for innovation in areas such as financial technology, education, and infrastructure. As countries develop and implement their own digital currencies, they will need to build the necessary technological infrastructure to support these systems. This could lead to significant investments in blockchain technology, digital wallets, and other related innovations, creating new opportunities for businesses and entrepreneurs in the tech sector. Additionally, as more people gain access to digital currencies, there will be a growing demand for education and training in how to use these new financial tools, creating opportunities for educational institutions and service providers. In conclusion, the launch of a new digital currency by an African nation represents a significant turning point in the global financial system. The move challenges the dominance of Western banks and institutions, offering a path to greater financial independence and sovereignty for developing nations. However, it also highlights the resistance that these new financial technologies will face from traditional power structures. The freezing of assets by Western banks serves as a reminder of the immense power that these institutions still wield over the global economy, but it also underscores the growing potential for digital currencies to reshape the way financial transactions are conducted around the world. As the world moves further into the digital age, the role of digital currencies in global finance will only continue to grow. Whether this new currency will succeed in challenging the dominance of the traditional financial system remains to be seen, but one thing is certain: the financial world is changing, and the future of money may be far more decentralized than we have ever imagined. The coming months and years will undoubtedly be critical in determining the future trajectory of this new financial landscape, and how countries around the world choose to respond to the rise of digital currencies will shape the global economy for generations to come. The launch of a new digital currency by an African nation marks a significant disruption to the long-established global financial order, which has been largely shaped by Western powers. For decades, the global financial system has been controlled by institutions based in the United States and Europe, such as the International Monetary Fund, IMF, the World Bank, and a network of powerful commercial banks. These institutions, along with the dominance of the US dollar, have shaped the way countries engage in international trade, manage their economies, and navigate crises. By launching a digital currency, the African government has made a calculated move to weaken this historical monopoly and establish its own economic framework, independent of the Western-dominated system. The introduction of a state-backed digital currency is not just a technological advancement, but a political and economic statement. Digital currencies, particularly those built on blockchain technology, offer an alternative to the conventional financial system. Unlike traditional currencies, which are governed by central banks, digital currencies are decentralized, meaning they are not subject to the control of a single authority. This decentralization provides a unique opportunity for developing nations to bypass the economic leverage that Western financial institutions hold over them. In doing so, these countries are taking steps to assert their sovereignty in a financial system that has often marginalized them or placed them at the mercy of foreign powers. The digital currency is also a direct challenge to the dominance of the US dollar in global trade. For many years, the dollar has served as the primary reserve currency, meaning that international transactions are often conducted in dollars, and countries hold vast reserves of the currency. This system benefits Western economies by giving them greater control over global finance. By launching their own digital currency, countries like this African nation are signaling that they no longer want to be bound by the dominance of the dollar. They are seeking a new financial paradigm where their economic interests are not dictated by Western powers and where they can more freely control their monetary policy. Moreover, this move to a digital currency also exposes a growing desire for financial autonomy within the global South. The African Nations Initiative serves as an example for other nations to consider how they too might break free from the entrenched systems that have historically disadvantaged them. The global financial landscape is slowly shifting, and this development signals that the era of unquestioned Western dominance may be coming to an end. The introduction of a digital currency by an African nation is a decisive step toward achieving financial sovereignty and economic independence. For many developing countries, particularly those in Africa, economic policies have long been shaped by the influence of external financial institutions like the International Monetary Fund, IMF, and the World Bank. These institutions, while often offering much-needed financial aid, have also been criticized for imposing stringent conditions that can limit a nation's ability to pursue independent economic strategies. These conditions typically come with demands for austerity measures, privatization, and structural adjustments that can harm domestic economies and exacerbate inequality. In this context, the Digital Currency Initiative represents an attempt to break free from the cycle of reliance on external debt and foreign capital. Traditional financial systems controlled largely by Western banks and institutions have created a dependency that is difficult to escape. Countries seeking loans or financial assistance often find themselves caught in a web of debt, paying back loans under unfavorable terms while still struggling to grow their own economies. With this digital currency, the government can directly control the issuance of money without relying on external banks or investors. This gives them the flexibility to implement economic policies tailored to their own needs without having to compromise on the terms set by foreign institutions. It is a move that reduces the nation's vulnerability to global financial crises, fluctuating interest rates, or the volatile swings of international markets. Instead of relying on foreign aid or loans, the nation can generate and manage its own resources, empowering local businesses and entrepreneurs and creating a more resilient domestic economy. Furthermore, a national digital currency can serve as a tool for greater economic inclusivity. Many people in developing countries are excluded from traditional banking systems due to geographical, economic, or social barriers. The launch of a digital currency represents a significant step toward increasing financial inclusion, particularly in developing countries where a large portion of the population remains unbanked or underbanked. Traditional financial systems, with their reliance on physical banks, credit institutions, and centralized financial hubs, have often excluded millions of people from basic banking services. This exclusion is not just a matter of access to financial products, but also of economic opportunity, as many individuals in underserved regions lack the means to participate in the formal economy. Digital currencies, however, present a unique opportunity to bridge this gap and bring financial services to those who have traditionally been left out. One of the key advantages of digital currencies is their ability to bypass the physical infrastructure that has limited access to financial systems in rural or remote areas. In many parts of the world, especially in sub-Saharan Africa and other developing regions, opening a bank account or accessing loans can be a complex and costly process. This ease of access is crucial for populations who may not have a stable income or a formal job, but still need a secure and efficient way to manage their finances. With a digital currency, people can create secure digital wallets to hold their money, conduct transactions, and save for the future without the need for a traditional bank account. This could be especially beneficial for small-scale entrepreneurs, farmers, and informal sector workers who operate outside the formal financial system, but still need a reliable way to make payments or save money. By facilitating these everyday financial activities, digital currencies can empower individuals to take control of their financial futures, reducing their reliance on cash and informal networks that are often fraught with risk and inefficiency. Ultimately, the increase in financial inclusion brought about by a national digital currency could have profound effects on social and economic development. By providing a means for individuals to participate in the global economy, digital currencies can create new opportunities for entrepreneurship, savings, investment, and financial independence. This could help lift millions out of poverty, empower women and marginalized groups, and stimulate local economies by fostering financial autonomy and reducing reliance on traditional financial systems that may be unwelcoming or inaccessible. In a world where financial inclusion is a key driver of economic growth, the potential of digital currencies to level the playing field cannot be overstated. The swift and harsh retaliation from Western banks following the launch of a digital currency by an African nation underscores the entrenched power dynamics within the global financial system. The decision to freeze assets held by the country's financial institutions and businesses in Western banks is not just a financial maneuver, it is a clear political and economic response aimed at preserving the dominance of traditional financial structures. This action reveals how much control these institutions still have over the flow of capital and resources across borders, and how they are willing to use this power to protect their interests in the face of any challenge. Western banks have long had a monopoly on global financial markets, with the United States dollar serving as the de facto global reserve currency. This centrality has granted Western financial institutions not only economic power, but also geopolitical leverage. The freezing of assets is a manifestation of this leverage. By cutting off a country's access to international capital markets, Western banks can exert significant pressure on that nation's economy, making it more difficult for it to trade, invest, or borrow money from foreign sources. This move serves as both a financial and political signal that any attempts to disrupt the existing global order will not be tolerated. For the African nation in question, the asset freeze could have serious ramifications. Access to global financial markets is vital for conducting international trade, securing investments, and maintaining economic stability. By denying access to these resources, Western banks are effectively isolating the country from the broader global economy, which could result in inflation, a decline in foreign direct investment, and difficulty in meeting the needs of its population. This type of financial isolation can lead to a spiral of economic instability, making it harder for the country to achieve the goals set out by its government, including fostering domestic growth and improving the standard of living for its citizens. The response from Western banks also highlights a deeper issue, the geopolitical battle over the future of global finance. By launching a national digital currency, the African government is signaling its intent to break away from the influence of Western financial institutions, and Western powers see this as a direct challenge to their authority. The freezing of assets is a tool of coercion meant to force the country to reconsider its stance and return to the traditional financial system where Western institutions hold sway. This reaction is not just about the economics of currency, but about the preservation of global financial hegemony. The freezing of assets raises critical questions about the power dynamics in the global financial system. It reveals that while digital currencies promise greater financial autonomy and decentralization, they also expose the vulnerabilities of countries attempting to assert their economic independence. Western banks can wield significant influence over national economies simply by controlling access to the global financial system, demonstrating how much control these institutions still retain over global financial transactions, even in an age where digital currencies and blockchain technologies offer alternatives to centralized banking systems. However, this kind of retaliation also risks driving more nations toward alternatives to the traditional financial system. By using financial sanctions and asset freezes, Western institutions may be pushing countries to seek out more decentralized financial systems that operate outside of their control. If the message sent by Western banks is that they are willing to use their power to punish those who try to circumvent the traditional financial order, other nations may view these actions as further evidence of the need for a new financial model, one that is not subject to the whims of a small group of powerful financial institutions. This could accelerate the adoption of digital currencies and blockchain technologies, potentially leading to the development of more diverse and independent financial systems. Furthermore, the asset freeze exposes the vulnerability of the current financial system, which remains highly centralized and susceptible to manipulation by powerful institutions. The fact that a small group of Western banks can freeze the assets of a sovereign nation's financial institutions highlights the risks involved in relying on centralized systems, especially when those systems can be used as instruments of political power. It also underscores the need for more robust and resilient financial infrastructure that is less susceptible to the kind of leverage that Western banks have exercised in this situation. In the long term, the retaliation by Western banks could backfire by catalyzing the shift towards more decentralized financial systems. As digital currencies gain traction and countries begin to explore alternatives to traditional banking systems, these retaliatory measures may serve as a catalyst for change rather than a deterrent. They could prompt other countries, particularly those in the global south, to explore similar initiatives that reduce their dependency on Western-controlled financial institutions. This could further erode the influence of Western banks and pave the way for a more diverse and decentralized global financial system, one in which countries have greater control over their own economic futures. While the freezing of assets is a powerful short-term tactic, it could ultimately contribute to the very trend it seeks to prevent: the diversification and decentralization of global financial systems. The African nation's decision to launch a digital currency has sparked a broader conversation about the future of money, sovereignty, and the power structures that shape the global economy. In the face of Western banks' retaliation, the question remains: will these institutions succeed in maintaining their dominance, or will this be the beginning of a new era where digital currencies and alternative financial systems provide greater autonomy and independence for nations around the world? The launch of a national digital currency by an African nation, coupled with the Western banks' swift retaliation, presents an undeniable inflection point in the global financial landscape. This event is not simply a financial innovation, but a potential catalyst for a new era in global finance, one where decentralization, digital currencies, and alternative financial systems could reshape the dynamics of power, economic policy, and cross-border trade. As more countries look to break free from the traditional financial structures that have long been dominated by Western powers, the stage is set for a profound transformation in how money is created, managed, and exchanged across the globe. The most immediate and visible consequence of this shift is the rise of digital currencies, which offer an alternative to the fiat currencies controlled by central banks and the global financial institutions that govern them. Blockchain technology, the underlying system for most digital currencies, operates on a decentralized network, meaning it does not rely on traditional intermediaries like commercial banks or government regulators. This decentralization has the potential to democratize financial systems in ways that have never been possible with centralized systems. By giving individuals and nations greater control over their own financial transactions, digital currencies can empower people in countries with less developed financial infrastructure to participate in the global economy. The implications of this shift go beyond just technological advancements. The increasing acceptance and integration of digital currencies can lead to the emergence of a more multipolar global economy. Traditional economic power has long been concentrated in the hands of a few major players, particularly the US, the EU, and a handful of large commercial banks. These institutions control not only the flow of capital, but also the rules that govern international trade and investment. However, as more countries explore digital currency options and reduce their reliance on the US dollar and other dominant fiat currencies, a more diverse financial ecosystem could emerge. This would allow nations to transact using their own currencies or other alternative currencies, reducing the monopoly of any single nation or institution over global trade. One of the most significant benefits of this new financial era could be the empowerment of the global South. For decades, developing nations have been at the mercy of international financial institutions like the IMF and the World Bank, which have often imposed harsh conditions on loans and aid. These conditions have limited the sovereignty of countries, forcing them to adopt economic policies that may not align with their domestic needs. By adopting digital currencies, countries in Africa, Asia, and Latin America could regain greater control over their financial policies and reduce their dependency on foreign debt. This could lead to a more equitable global economic order, one in which smaller and emerging economies have more influence and agency in shaping their financial futures. Moreover, the rise of digital currencies could pave the way for financial inclusion on a global scale. Today, billions of people, particularly in developing countries, remain unbanked, unable to access basic financial services such as loans, savings accounts, and secure payment systems. Traditional banking systems have long been excluded by high fees, limited infrastructure, and geographical barriers. Digital currencies, by their nature, offer a solution to this problem. As long as individuals have access to mobile phones and the internet, they can engage in digital transactions, send and receive money, and save securely. This could significantly reduce poverty, empower entrepreneurs, and enhance economic activity in regions that have historically been left out of the financial system. One of the key challenges, however, will be navigating the regulatory landscape. As digital currencies gain traction, governments and financial regulators around the world will need to adapt to a rapidly changing environment. The existing regulatory frameworks that govern international finance, developed over the past century, were built around the needs of traditional centralized systems. As digital currencies grow in popularity, there will be increasing pressure to create new legal frameworks that govern these currencies and ensure that they can be used safely and securely without undermining existing financial structures. The response from governments will vary. Some may see digital currencies as a threat to their authority and financial stability, while others may embrace them as a means of increasing sovereignty and fostering innovation. In addition, the rise of decentralized financial systems could lead to increased innovation in other areas of finance. Blockchain technology is already being explored for use beyond just currency, including in areas like supply chain management, voting systems, healthcare records, and insurance. As nations and businesses begin to experiment with these technologies, the potential applications could be vast, fostering a new wave of technological innovation that disrupts a variety of industries. The broader adoption of digital currencies could also drive innovations in digital wallets, payment systems, and financial services, creating new opportunities for entrepreneurs and startups to enter the financial sector and offer services that were once the exclusive domain of large, established banks. As the digital currency experiment unfolds, there is also the potential for increased cross-border cooperation. While Western financial institutions are currently using their power to isolate the African nation from global financial markets, the global response could be one of solidarity and innovation. Developing countries that see the value in digital currencies might look to form new alliances and economic blocs that are less dependent on the traditional financial system. This could lead to the creation of new trade agreements and partnerships where countries share a common interest in reducing the influence of Western financial powers. By bypassing the traditional banking system, these nations could negotiate directly with one another, reducing the need for intermediaries and lowering transaction costs. In the long run, the emergence of digital currencies could ultimately lead to a more equitable and decentralized global financial system. Instead of a system where a small group of Western banks and nations control the flow of capital and dictate the terms of trade, the financial world could evolve into a more diversified and resilient network of national and regional economies. Digital currencies could serve as the building blocks of this new system, where nations can engage in global trade without being at the mercy of foreign financial powers. In conclusion, the launch of digital currencies represents much more than a financial innovation. It symbolizes the potential for a new era of financial autonomy, inclusivity, and decentralization. As more countries explore alternatives to traditional banking systems, the global financial system could transform into one that is more democratic, flexible, and resilient to the challenges posed by geopolitical and economic shifts. The coming years will be crucial in determining how this new financial era unfolds, but the signs are clear. Digital currencies have the potential to reshape the future of money and finance on a global scale.